6 Money Lessons from the Psychology of Money That Changed My Life. The book The Psychology of Money by Morgan Housel is full of valuable insights about money and personal finance. Here are 6 key lessons from the book that could potentially change your life. Absolutely, the concept that time matters more than money is a fundamental lesson in personal finance and investing. Here's a deeper explanation of why time is such a critical factor in building wealth. Compound interest. Time allows your investments to benefit from the power of compound interest. When you invest your money, you earn returns on your initial investment, and then those returns generate additional returns. Over time, this compounding effect can significantly increase the value of your investments. The longer your money is invested, the more it can grow. Risk mitigation. Time also helps to mitigate the impact of market volatility. Over long periods, the ups and downs of the market tend to smooth out. Short-term market fluctuations are less relevant when you have a long-term investment horizon. Dollar cost averaging. By investing regularly over time, you can take advantage of dollar cost averaging. This means you invest a fixed amount of money at regular intervals, regardless of market conditions. When prices are high, you buy fewer shares, and when prices are low, you buy more shares. This strategy can help reduce the impact of market timing and ultimately improve your average cost per share. Emotional stability. Long-term investing encourages emotional stability. It's easier to stay calm during market turbulence when you have a long investment horizon. Short-term fluctuations are less likely to lead to impulsive decisions. Goal achievement. Financial goals, such as retirement or saving for major expenses, often require decades of consistent saving and investing. The sooner you start, the more time you have to work towards those goals. In summary, the longer your money is invested, the more time it has to grow and benefit from the compounding effect. This is why it's crucial to start saving and investing early in life. Time can be a more valuable asset than having a large amount of money to invest because it allows your wealth to grow exponentially over the long run. The idea that behavior matters more than knowledge in the realm of personal finance is a crucial concept from The Psychology of Money by Morgan Housel. Here's a more in-depth explanation of this important concept. Emotional decision-making. Even if you possess a wealth of knowledge about investing and financial principles, emotions can still lead you to make irrational decisions. It's not enough to know what you should do, you need to manage your emotions and behavior to act on that knowledge. Timing and patience. Investors often make poor decisions when they react to short-term market fluctuations. Knowledge may tell you that markets can be volatile, but if your behavior leads you to buy or sell based on fear or greed, you can harm your long-term returns. Patience and a steady hand are essential. Consistency. Successful financial behavior often involves consistent actions over time. Regular saving, disciplined spending, and a consistent investment strategy can be more important than trying to time the market or find the latest investment fad. Risk management. Your behavior plays a critical role in managing risk. Diversifying your investments, setting appropriate asset allocation, and rebalancing your portfolio as needed are all behaviors that help manage risk. Even if you understand these concepts, you must act on them. Long-term perspective. Behavior that focuses on the long term is essential. Many people sabotage their financial goals by getting too caught up in short-term gains or losses. Knowledge tells you to think about your long-term financial future, while behavior helps you stay on that path. Adaptability. Adaptability in financial behavior is also important. As your financial situation changes, you may need to adjust your strategies. This may mean increasing your savings, rebalancing your portfolio, or making other financial decisions based on your evolving needs and goals. In essence, while knowledge is certainly valuable, your financial success is heavily influenced by how you apply that knowledge through your behavior. Emotion-driven decisions, impatience, and a lack of consistency can hinder your financial progress, regardless of how much you know about money and investing. Developing sound financial habits and behavioral discipline is often the key to long-term financial well-being. The concept that risk is personal is a fundamental idea in the field of personal finance and investing. It emphasizes that risk tolerance and capacity vary from person to person, and it's essential to understand your own risk profile when making financial decisions. Here's a more detailed explanation of this concept. Risk tolerance refers to your psychological and emotional ability to withstand fluctuations in the value of your investments. Some individuals can tolerate higher levels of risk and are comfortable with the potential for greater investment volatility. Others may be more risk-averse and prefer a more conservative approach. Your risk tolerance can be influenced by factors like your age, financial goals, and personal temperament. Risk capacity is your financial ability to withstand investment losses. It is influenced by factors like your income, savings, and overall financial situation. If you have a significant safety net or financial reserves, you may have a higher risk capacity. On the other hand, if your financial situation is more precarious, your risk capacity may be lower. Balancing risk: the key is to strike a balance between your risk tolerance and risk capacity. While it's essential to invest in a way that aligns with your comfort level, it's also necessary to ensure that your investment strategy aligns with your financial goals and resources. Diversification is a strategy that can help manage risk. By spreading your investments across different asset classes, you can potentially reduce the impact of a poor-performing asset on your overall portfolio. Diversification allows you to customize your risk exposure while aiming for a balance between risk and potential returns. Periodic reassessment: your risk profile may change over time due to changes in your life circumstances, financial goals, or personal preferences. It's important to periodically reassess your risk tolerance and capacity and adjust your investment strategy accordingly. In summary, risk is personal underscores the importance of tailoring your investment strategy to your unique financial situation and emotional comfort. Understanding your own risk profile is a critical step in making informed investment decisions and achieving a balance between your financial goals and your capacity to withstand risk. The idea that avoiding big mistakes is more important than being perfect is a pragmatic and important concept in the world of personal finance and investing. Here's a more detailed explanation of this concept. Risk mitigation: in investing, it's nearly impossible to avoid all losses or mistakes. Markets can be unpredictable and sometimes volatile. Instead of striving for perfection, it's often more practical to focus on minimizing significant mistakes or losses. This can be achieved through diversification and careful risk management. Emotional impact: trying to be perfect in your investment decisions can lead to high levels of stress and emotional strain. Fear of making mistakes can cause you to be overly cautious or make impulsive decisions based on short-term market movements. Avoiding big mistakes means acknowledging that small errors will happen but shouldn't have a long-term impact on your financial well-being. Cost of inaction: an obsession with perfection can lead to the cost of inaction. If you're always waiting for the perfect investment or market timing, you may miss out on valuable opportunities for growth. Avoiding big mistakes often means taking a balanced and proactive approach to investing. Long-term perspective: long-term investors recognize that the market will have ups and downs. It's often more important to stay invested and focused on your long-term goals rather than trying to time the market or make perfect decisions in the short term. Learning from mistakes: small mistakes and losses can be valuable learning experiences. They can help you refine your investment strategy and make better decisions in the future. Focusing on avoiding significant errors allows you to grow and improve as an investor. Diversification and risk management: diversifying your investments across different asset classes and employing risk management strategies can help prevent big financial setbacks. These practices help protect your portfolio from substantial losses. In essence, striving for perfection in investing can be counterproductive and emotionally draining. Instead, it's often wiser to aim for a sound, well-balanced investment strategy that minimizes significant mistakes while accepting that smaller missteps are a natural part of the investment journey. The key is to learn from your experiences and continue moving toward your long-term financial goals. The concept that saving is more important than investing is a fundamental principle of personal finance. While both saving and investing are important, saving is often considered the foundational step in building a strong financial foundation. Here's a more detailed explanation of this concept. Liquidity and emergency funds. Saving money provides you with liquidity and the ability to meet unexpected expenses. Before you can invest, it's crucial to have an emergency fund that covers 3 to 6 months of living expenses. This fund acts as a financial safety net, preventing you from needing to sell investments in a downturn or go into debt when unexpected bills arise. Foundation for investing. Saving is the first step toward investing. Without savings, there is nothing to invest. You need money set aside to put into investments such as stocks, bonds, or real estate. The more you save, the more you have available to invest. Short-term financial goals. Saving is essential for achieving short-term financial goals, such as purchasing a car, taking a vacation, or buying a home. Investing is generally better suited for longer-term objectives like retirement. Stress reduction. Having savings gives you peace of mind. It reduces financial stress and provides a sense of security. When you have money saved, you are less likely to rely on credit cards or loans for unexpected expenses. Risk mitigation. Saving reduces your dependence on investment returns for your financial well-being. Investments inherently come with risk, and their performance can be unpredictable. Saving provides a more stable and predictable source of funds for short-term needs. Building financial discipline. Saving encourages financial discipline. It involves setting aside a portion of your income on a regular basis, which can help you develop good financial habits and control your spending. Compound interest. While saving accounts typically offer lower returns than investments, they still generate some interest. Over time, this interest can grow your savings, especially when kept in high-yield savings accounts or certificates of deposit, CDs. In summary, while investing is crucial for long-term wealth accumulation, saving provides the financial foundation on which investing is built. Having a strong savings habit, an emergency fund, and short-term savings goals in place is a critical first step before you dive into the world of investing. Both saving and investing should be part of your overall financial strategy, with each serving a distinct purpose in your financial journey. The concept that wealth is what you don't see is a thought-provoking idea presented in The Psychology of Money by Morgan Housel. It challenges the traditional notion of wealth being primarily about conspicuous consumption and extravagant displays of affluence. Here's a deeper explanation of this concept. Hidden wealth. True wealth is often hidden from plain view. It's not about the flashy cars, opulent homes, or extravagant lifestyles that people often associate with being rich. Instead, it's about the financial assets, investments, and savings that are quietly accumulating and growing over time. It's what you save, invest, and manage wisely that truly defines your wealth. Long-term accumulation. Building wealth is a gradual and often uneventful process. It's about consistently saving, investing, and letting your money grow over the long term. This process might not be immediately visible to others, but it's the cornerstone of financial success. Financial security. True wealth is about financial security and peace of mind. It's having the resources to weather unexpected expenses, job losses, or economic downturns without financial stress. This security is not often apparent in the same way that luxury items are. Living below your means. Wealth often comes from living below your means and maintaining a modest lifestyle. People who focus on saving and investing rather than excessive spending are more likely to accumulate wealth over time. Compound growth. Wealth is the result of the magic of compound interest and investment returns. Small, consistent contributions to your savings and investments can grow exponentially over the years, even if the growth is not immediately apparent. Legacy and generational wealth. True wealth can be passed down to future generations, enabling your family to enjoy financial stability and opportunities. This form of wealth is often invisible but has a profound impact on your family's well-being. In summary, wealth is what you don't see underscores the importance of a more prudent and long-term approach to financial management. It's about focusing on accumulating assets, investing wisely, and ensuring your financial security rather than chasing conspicuous consumption. This concept encourages you to look beyond surface appearances and prioritize the substantial financial foundation that lies beneath. By understanding and implementing these lessons from the psychology of money, you can make more informed and deliberate financial decisions that can positively impact your life and long-term financial well-being.